Very good afternoon, friends. ICAI Krishna Garg, Secretary CGST, Tax Practitioners in Association Indore, welcome you to this webinar organized jointly with ICAI Indore branch. Friends, construction services are always a matter of litigation. We all remember that there were so many disputes relating to construction services in the service reg regime also. Some of them are still there in GST also. Friends, after Gujarat AR in case of Dipesh Anil Kumar Nayak, now what I can see is that there are a lot of complexities with the taxability of plotted development of land. Further, now we can see that plot development is also done under JDA. So now some of the burning issues are there with us, which is whether plotted development land is taxable under GST. Secondly, in case of JDA, whether this involves TDR, and if yes, then its taxability issue is there. And time of supply, lastly, its valuation. So there are so many issues are there with us. So looking to the need for an expert view on these issues, today we have organized this webinar diving into GST complexities involved in plotted development of land. Friends, we are fortunate enough to have an expert on this subject, Senior Advocate K. Vaitheeswaran sir from Chennai. Further, it's a matter of great honor that sir is going to speak for for this first time at any forum in Indore. So, sir, Vaidhees sir, I welcome you in this webinar. Now, before diving into the complexities, I would like to invite CA Manoj Gupta ji, President Tax Practitioners Association Indore, for his opening remarks.
Thank you, Krishna ji. Good afternoon, friends. Definitely, we are having webinars on various subjects of GST since a very, very long time. Since the last lockdown, we had seminars on various subjects, starting from the advanced ruling, case laws to input tax credit and various many subjects. But friends, as we know that real estate is always been a controversial subject, whether it is GST or whether it is Income Tax Act. So it is better. Of course, I can't say that all the controversies will be over today, but it's always better to discuss and have a view of the experts so that we may take a conscious view on problems of our clients. We are definitely very fortunate that Vaitheeswaran ji from Chennai who is a very senior advocate, has consented to speak on this very important topic for this our Indore fraternity. So I welcome him, and I hope that today's webinar will be very useful and will throw a light on various controversial subjects. With these remarks, I hand over to Krishna ji for further proceedings.
Thank you, Manoj ji. Moving further, friends, as I told you, Vaitheeswaran is a very senior advocate from Chennai. He obtained a law degree from Madras Law College and started his career as an advocate in the year 1990. Apart from law degree, he is grade CWA and has also completed ACS from ICSI. His legal firm operates with physical offices at Chennai and Bengaluru and provides services virtually across the country. He has over 30 years of experience in advisory capacity as well as thorough experience as well as through appearance before appellate authorities, tribunals, and courts in matters arising under domestic and international tax laws, excise and custom, service tax law, VAT, CST, GST, FEMA, RERA, company law, and IBC. He has written hundreds of articles and books covering variety of issues in tax, corporate law, constitution law, and general laws in both print and digital media. He has recently authored the books Taxation of Digital Economy. That is a very important subject. So he has recently authored the book Taxation of Digital Economy, published by Oakbridge, covering international tax and indirect tax aspects of the digital world. He is considered as a specialist in tax and legal matters with an in-depth knowledge of the business and tax laws. He has addressed hundreds of seminars and conferences on law and taxation across the country. He is an expert in real estate contracts and has recently forayed into technology law and artificial intelligence. He advises clients across the country on various verticals such as manufacturing sector, retail, healthcare, food, everything he has covered, food and hospitality, gems and jewelry, etc. He also advises various associations and chambers of commerce. He is the chairman of the expert committee on GST, Madras Chamber of Commerce and Industry. He is also a member of SIC, Indo-American Chamber of Commerce. He is recipient of Vocational Excellence Award from the Rotary Club of Madras Southwest. He is actively involved in various social causes through music and also forays into humor writing. Friends, in my view, he is not only an authority on indirect taxes issues, but also on direct taxes. And it is really a rare combination. And I hope that one day we will hear from him on the matters of direct tax as well. Above all, by profession, he is an advocate, but by heart, he is an excellent singer. Sir, I always remember your song Surmai Akhiyon Mein, which you presented in one of the conference which I attended. With this small introduction, now I would like to invite Vaidhi sir to start his discussion. Sir, with all your expertise, we all are eager to dive into all the aspects of these controversial issues. Over to you, sir.
Thank you so much. Thank you for those wonderful words. It's a pleasure to be part of this session, and the virtual world has enabled this kind of connect. Otherwise, it will be probably 2 to 3 days to travel and plan a trip to Indore. Though I've come to Indore, I've come on one of those international tax events where I was a speaker, and Indore was simply brilliant. I spent about 2 days there, and it is nice to again connect once again to this virtual world. If you can start the presentation, I'll go straight into the topic.
Okay, sir. Okay. Just a minute, sir.
Next slide.
Par.
Next, please.
Just a minute, sir. Yes, sir.
So let me start with some kind of a statutory warning, like what we see in films, that no animals were harmed during the shooting of this film. Smoking is injurious to health. Smoking causes cancer. Alcohol is dangerous. Those kind of things. I will start with the preamble by saying that AARs are binding only on the applicant and the department having jurisdiction over the applicant. I'm still not able to understand or appreciate why there is so much of enthusiasm to knock the doors of AAR. While I do understand that GST is quite complex and the subject is quite tricky in terms of various scope of interpretation, the overall the exuberance and enthusiasm amongst the professional world to advise their clients to knock the doors of AAR is inexplicable. Because what happens is almost 90 to 95% of the rulings are in favor of the revenue. Very few are in favor of the SSCs, and that too gets reversed subsequently. So despite that, people still go and knock the doors of the AAR and ask questions, and they get answers. And real estate is no exception. They have asked certain questions and they've got certain answers. So while I may touch upon one or two AARs in the context of the topic that is involved, my statutory warning remains that they are not precedents, they are not judgments, they are not judicial decisions, they are not binding on you. And mainly because you can't blame the AR, because the AR is manned by sitting officers from the department. It is not having a High Court retired judge or retired Supreme Court judge, and therefore the judicial mindset may not be there, given the fact that sitting officers have to decide. It's not even like an appellate authority. Even an appellate authority would approach it in a different way, and hence you have this kind of challenges. Next, please. Next. So this is the case study which Kishan shared with me. So I thought the context would be set. If these are typical facts, Raman Co owns land, carries out all development activities, prepares the layout, and sells the plots in various sizes. So a couple of questions have been raised as to whether there is some kind of a difference between land and land which is converted into a plot. And then a question as to whether if somebody sells a developed plot, it's a service. Then another business model where an agreement is signed for the sale of the land for a particular consideration, let us say X. And then there is another agreement for Y, which is development charges. So if X is collected separately and Y is collected separately, what is the position? If both X and Y together are collected for the sale transaction, what is the position? And is there any kind of impact or change if completion certificate is obtained or issued under the local law? And finally, what would be the impact of ITC or availability of ITC in the entire transaction? These are some of the questions, sub segments of the question. I'll elaborate it as I go further into facts. Next. So first, like an opening bowler who would like to take the first opening batsman out with full pace, I will bowl the required Yorkers to knock out the two ARs that seem to worry a lot of people. So let me look at this first AR ruling of the Gujarat AR in the case of Satyaja Infratech, where a ruling was given saying purchase of land and selling the said land by converting into integrated subplots of various sizes under the name Bliss Homes with basic facilities liable to GST. The activities would fall under 5B Schedule 2 of the CGST, GGNC, and hence 9% plus 9% is applicable in terms of so and so, so and so. Now let me dismiss the opening batsman. Next. Before I do that, the second batsman also comes from Madhya Pradesh, where Vidit Builders is a partnership firm. It is engaged in the business of real estate development. It is developing a colony by executing a JDA agreement with the landowner, Star Construction. There is a revenue sharing agreement of 60 and 40. MPAR ruled that the activities of the applicants amounts to supply of services under works contract and liable to be taxed. The value of supply is equal to the amount receivable by the applicant, which is equal to 40% of the amount on which the plots are sold. That, as per the ruling laid on by the so-and-so AR MP, 40% of the sale value of the plot representing the share value of the developer has been treated as taxable. Next. So my Yorker would be, why would I say those AR rulings are flawed? Now, first of all, we need to understand there is this general tendency to get overawed by the technicalities of a transaction without looking into primarily the substance of the transaction and getting unnecessarily clogged the way things have been portrayed or analyzed. Fundamentally, what is the transaction? Fundamentally, if you look at the transaction, it is nothing but sale of plot. And what is a plot? A plot is nothing but a plot created to convert some massive acres of land into some kind of meaningful divided plots where people believe that each of them become selfish owners of a specific area of land and they enjoy exclusive ownership and possession and prevent others from entering into that domain, and they also do not enter into the other person's domain. So it is basically the human mind which says that this is mine and therefore the plot is mine. But ultimately it is land. The land could have been acreage of land with shrubs and bushes and trees which are overgrown and weeds, etc. Mounds of small mountains or hills that have been occupying that land, and there could be even some kind of water segments here and there. That land is leveled, all the shrubs and bushes and other things are removed. Some kind of flat surface is created across the entire facility to the extent possible, And then the land is further subdivided and plots are created. Local laws mandate that before you do all these things, you must get necessary permissions, you must get necessary clearances. You can't just like that do a layout. Therefore, you get local permissions. Local law also would mandate that you must create roads, you must create infrastructure, because one cannot fly from one plot to another plot. This is not Harry Potter. Therefore, they need movement. Well, the local laws will also mandate that once you create a community of 100 plots or 200 plots, it's a nagar that is getting created. And therefore, we need parks, we need open areas. And therefore, local laws would mandate that you must gift away some kind of area to the local municipality for putting up a park, etc. So somebody takes on this responsibility. The developer takes on this responsibility. He then does all these activities, makes that land a saleable land. That's all. It remains land. You may call it plot. You may call it a half ground plot. You may call it a 1 ground plot. You may call it a beautiful greened plot. You may call it whatever you want it, but it is underlying land. So land is converted into land and sold as land. How much ever terminologies you may use, it's still land. Therefore, sale of plot is clearly sale of land and outside GST, and therefore the AR rulings are clearly wrong. Construction of complex in the context of construction is in the context of commercial construction or residential construction, and it always comprises a complex. Typically, somebody is constructing a commercial complex or residential complex or constructing villas, etc. Nobody constructs land. You cannot construct land. Land is already there. At best, you're making it marketable. At best, you're making it habitable. At best, you're making it livable. At best, you're making it in some kind of attractive form, which is now known to the public as plots. See, before all this happened, we need to understand also how housing has evolved. The earlier days where you won't have a plot of land, you will have huge area of land where some house will be there in the middle, and the entire area might belong to you. You will be carrying out agriculture this side, that side, etc. Then slowly, villages became cities, and cities became congested cities, and difficulties in living happened. And then it was difficult to stay in one building, and apartments happened, and then you have high stories happening. So now you have, let us say, 20 stories where there are 40 flats where people are living, 40 families are living. Probably in that area, 40 families would have not lived before. Probably 2 families would have lived before. But it is still land. So on a land, when construction of complex takes place, that construction of complex is a separate service for which there may be a tax treatment. If commercial building is put up, there is a separate activity for which there may be a tax treatment. But when bigger land is converted into smaller plots of land, it does not tantamount to a construction of a complex. It does not become a building. It is not a commercial complex, and therefore nobody can say that it is a service and liable to GST. Next. Now we come to plot. Typically what happens, somebody has developed that plot. Let us call him a developer. In our case, Ram & Co is a developer. He has obtained all the local permissions. He has obtained all the clearances. In case environment clearance applicable, he gets environment clearances. And then he does all the cleaning and leveling and laying out, which I told you. And then drainage facilities are to be created. So sewerage, waterage, all facilities are to be created. Lights have to be laid down. Roads are to be carried out. Pavements are to be made if possible. If it's a big kind of a township, or if it's just plotting. Even for the plot identified land, there must be clear identification of small roads which separates the plots. And then conveyance is executed with each customer. This plot, say plot number 5 in so and so area, bounded by plot number 3, plot number 4, plot number 1, etc., is now being sold to you for X consideration. So as I said, plot is nothing but land. So there is no difference between land and a plot, land and a developed plot. It is still land. If it is still land, then third schedule comes to the picture. Third schedule of CGST Act is very clear when it says sale of land, subject to para 5B, sale of building, which we know. We are talking about construction complex. We are not engaged in that. We are engaged in sale of land, and therefore sale of land is not liable to tax. Clearly out of GST. Now, there is one more aspect to the whole thing. Again, this is modern development. Over a period of time, the tax environment has created new ideas. Those of you who are familiar with VAT practice, those of you who had practiced some element of sales tax, would know the history of how tax laws also evolved. For a long period of time, when somebody was putting up an immovable property, they would sell, I'm selling immovable property, I'm not liable to tax. But the government was very keen that, no, you may be putting up and selling immovable property, but to construct that, cement went inside, steel went inside, aluminum went inside, glass went inside, bricks went inside. Those are all goods. We want to tax it. Supreme Court said, no, it is sale of immovable property, you cannot tax it. And therefore, the Constitution was amended. That is how the 46th Amendment was born, and works contract came into the picture. So, for the first time, artificially, works contract was created, where in a construction contract, the materials were identified as liable to VAT or sales tax. Initially sales tax, then VAT. Then the central government said, okay, if the goods in the works contract can be subjected to sales tax, why not the service in the works contract be subject to service tax? And that is how service tax on works contracts were born. And therefore, as I said, people started looking at, okay, if it is a works contract, it is taxable. Then why not? I'm a developer, I'm not executing a works contract. I'm a pure developer, I'm not engaged in construction. Then Supreme Court said, even though you are a developer, you're entering into an agreement to construct an apartment or construct a unit, etc. And therefore, a developer contract is also a works contract. Now, when it comes to consideration, if I have 2,000 rupees per square feet as the consideration, the customer says the stamp duty rates are very high. Now, you have to understand, you have an Indian Stamp Act, and that's a parliament legislation. But states have also improved upon that legislation, or in some cases enacted a separate legislation in line with the central legislation. So, entry 63 empowers the state to levy stamp duty as far as state list is concerned. So, all states levy stamp duty as well as registration fee. Now, assuming the stamp duty rate is quite high. Now, let us assume, for an example, that it is 8%. And 2,000 rupees is the selling rate. Now, 2,000 rupees selling rate, the customer says 8% stamp duty is a bit too much. I can't afford to pay so much. So, market distortion happens. Now, two ways this can get sorted out. One, an unhealthy, unethical practice of undervaluation, where the valuation could be lowered down and cash could probably play a big role. But that is against the system, against the society, and against the tax laws, and that has got other complications also. So there also you would have seen the income tax law trying its level best to capture the market value instead of the agreed value. So if 2,000 rupees attracts an 8% stamp duty, and somebody says, no, this 8% is very high, then some developer comes with an idea saying that, why should I have 2,000 as a consideration? Why can't I have 1,500 as a consideration, which will still be the market value? And I'll charge 500 for the development charges. After all, I'm also only doing development. I'm removing the shrubs, I'm removing the bush, I'm leveling the land, I'm getting the permissions, I'm doing so much of activities. Why can't I charge 500 rupees development charges for that? Why can't I enter into a development agreement for that? So development charges agreement 500 rupees and sale deed or conveyance 1,500 rupees. Why cannot I do true transaction? So somebody comes out with that idea, and one person comes up with that idea, it is successful, and he gets the market for some time. The other person says, okay, this seems to be an effective one, it has worked, I'll also do. And then over a period of time, it becomes a practice. So today you have a practice whereby somebody executes a single document for 2,000 rupees as sale of plot, and somebody else executes a document for 1,500 for sale of plot and 500 rupees for development charges. Now the question naturally would arise, what is the GST implication? Now, as far as the sale of plot is concerned, it is a no-brainer. It is a sale of land. Third schedule, you clearly come into the picture and therefore not taxable. Then the question is, okay, is development charges taxable? Then one would have to read the definition of composite supply. So then composite supply in the CGST Act talks about a peculiar kind of transaction where there is a principal supply and an incidental supply, more than one supply. And the other supply is incidental to the main supply or principal supply and therefore takes a color of the principal supply. So the principal supply is taxable, the other supply is taxable. If the principal supply is exempted, the other supply is also exempted. So one may offer to examine the proposition that the development charges is nothing but incidental to the sale of land, and therefore sale of land is not liable to GST. Development is also not liable to GST. That would be your composite supply theory. Another person might say that no, why break my head on all those things? On the development charge, I'll rather pay GST. I'll pay 18% GST. And for carrying out the development, I would have engaged some engineers, I've engaged some contractors, I've engaged some small service providers, I've engaged some person who surveys the land and other things like that. Therefore, they will all charge me GST. I'll take credit on that. Then you have added to plot, you have power of attorney transactions, and then you have income tax implication. So plot as such has got too many plots or subplots within, if I may do a poor joke in it. And then we'll have to see each of the implications as we go forward. So I would explore all this in the next set of slides. Next. So coming to development charges. Now, if I go to development charges, the first thing that comes to my mind is that in the service tax regime, there was a decision. Chennai bench of the tribunal in the case of Hallmark Infrastructure held that service tax cannot be levied on the consideration collected as land development charges. The tribunal accepted the arguments that the development act is undertaken before sale of land, and hence the service is a self-service and there is no service provider service recipient relationship. This is a beautiful decision which has touched upon a fundamental issue. Now, let us say I'm a vendor of a commodity. I have a showroom. Now, it is in my business to sell the goods. And if I have to sell the goods, I have to make my wares or products attractive. So my showroom, I make it attractive. I display my products very well. I keep cleaning the products every day. I do different lighting systems. I engage, I spend money on advertisement. When the customer comes into the mall, I make sure that he reads my product display everywhere so that he is tempted to walk into my showroom and buy my product. So I do all these things in connection with the selling of the product. Now, can you say that these are all separate services rendered? Can you say that marketing is a separate service done, display is a separate service done, stocking is a separate service done, advertisement is a separate service done? There is only one transaction, namely supply of goods. And for that, I do all these things. I'll factor all these costs, no doubt, while I arrive at my sale price. Therefore, my intention is to make my product attractive in the market and I incur all these expenditures. The very fact that these are called by a name would not take away from the fact that I'm selling my product. Now just transpose the whole thing to land development. A big acreage of a couple, let us say 120 acres of land is there with a lot of, as I said, access is not there. You look at it, it's full of wild shrubs and bushes. There are poisonous trees. There are snakes probably here and there. One or two monkeys could also be there. You don't know what is inside. If you enter, you don't know how to come out. Now, how would I make it marketable? I own the land. I still own the land. Therefore, I have to clear the whole thing, like the mansions of gods and asterisks. I have to clear all the trees. I have to clear all the shrubs. I have to do some degree of killing of the environment to ensure that some kind of a plotted structure emerges. Therefore, when I incur all these expenditures and clear the layout and make the plot available, I am still doing service for myself. The customer is yet to come into the picture. Only if I do all this, customer walks in. Therefore, even though I may collect it as development charges under a separate accounting head or under a separate nomenclature, what the tribunal said is there a service provider, service recipient relationship? If so, at what point of time? They said there's no such relationship. The development charge agreement and probably the sale of plot happen simultaneously. If it is going to happen simultaneously, I have not rendered the service to the customer. I have rendered the service to myself. And therefore, the tribunal took a view that there is no service involved. And they said without development, the plot is really not marketable. And development is critical for the plot to be identified as a marketable plot and hence not liable to service tax. Same analogy, same rationale could equally apply in GST. Next. Now, in the case of torrent power, the Gujarat High Court, the principal supply was of transmission and distribution of electricity. What the High Court said is, how can you supply electricity? How can you distribute electricity? How can you transmit electricity? You cannot do that unless you have electric line, unless you have electric plant, unless you have the electric meter. And therefore, they said the principal and related ancillary services go hand in hand, and one cannot be provided independent of the other. And therefore, they applied the composite supply theory. And then they said tax liability is written by treating such composite supply as a supply of principal supply of transmission and distribution of electricity. If principal supply of transmission and distribution of electricity is exempted, then the liability of related service is also exempted. Because there is one theory that is floating around in the market that composite supply can be applied only if the tax supplies are taxable. The theory is that only if the supplies are taxable, you can apply composite supply theory. But Gujarat High Court has said that nothing like that. Taxability exemption presumes taxability, or exemption indicates that it was taxable. So the rationale of that would equally apply. So let's look at it in a very different way. I would take it to next level pedestal. One may argue that you cannot apply composite supply theory. Why? Sale of land is not a supply. If sale of land is not a supply, development charges incidental to sale of land cannot be examined under the definition of composite supply. Fair point. So my answer to that would be, if sale of land itself is not taxable, development of the land which is prior to the sale of land and which is material to the sale of land even materializing, can it be taxed? So what cannot be directly taxed, cannot be indirectly taxed is a well settled principle. So I would apply that argument if somebody is going to say that composite supply would not apply. But two decisions, as I said, one is the hallmark of service tax, another is the torrent power in the context of Gujarat High Court, would be relevant in the discussion. Next. So for my answers as far as case study 1 is concerned, conveyance for land and development agreement, tax implications are as under. On the sale price paid to the developer, customer will pay the stamp duty and registration fee. On the sale price for the sale of flats to customers where landowner also sells, there could be complex arrangements. Sometimes the landowner says, you sell this much, I sell this much. Both of them could be sellers. In both cases, there is no tax. On the sale of land by the owners or the sale of land by the developers, it is still sale of land. You may call it land, you may call it plot, you may call it developed plot, you may call it super developed plot. It is still land and therefore not liable to GST. When it comes to development charges, my view would be that it may be possible to argue that the development charges are incidental to the sale of land and therefore not taxable. But as a word of caution, given the past experience and given the fact that Hallmark had to go up to tribunal to get a decision, there is every guarantee that any position that development charges are not taxable would land in litigation. So it largely depends upon the client. If the client is willing to take that litigation, fine, it is worthwhile to fight that matter. If the client says, I don't want this litigation, then you have a simple solution. Load both the 1,500 and 500 into your sale of land, one stroke, have an entire consideration for the land, there ends the matter. No, I want to have two consideration, one for the land transaction and one for the development charges. Then take a very conservative view and pay GST on development charges, and if possible, take ITC wherever applicable. Next. Now moving on to case study 2. XYZ owns land, enters into a registered agreement with the developer for developing the land. Stamp duty is payable on the registered development agreement on guideline value. Different models have been looked at. Area sharing model, when 60% of the plots are earmarked for the owner, whether GST is applicable, whether any development rights are involved in such transaction, whether developer is liable for GST on the sale of his own share of plots, whether developer is liable to GST on the developed plots handed over to the owner. If GST is applicable, what is the valuation, time of supply, and impact on ITC? Whether GST is applicable on revenue share model, whether owner is liable if he sells his share of plots. All these are the questions that are coming out of case study 2. I will attempt to answer these questions. Next. First of all, let's understand area share. Now, why would even an area share model come out in the market? The person who owns the land, let us say 25-30 acres of land, it could be 4 or 5 brothers or 3 brothers and 2 sisters owning the property. They might have inherited it from their parents or their ancestors. Or there is a property in the family for a long period of time. They are not very keen to divide the property. Such a big property is impossible to sell also because a lot of money is involved. No buyer is coming forward to buy the entire property and pay the full consideration. And the sellers are not interested in providing a time frame for consideration because defaults can happen. At the same time, the land has to be monetized. So as I always maintain, business comes with solutions and then tax laws try to move around the business solutions. So the business came with a solution saying that you are not in a position to sell. You can't sell because there's a huge tract of land, and unless you spend money first by clearing all the space and getting all the approvals, etc., you can't sell. You don't have the money to spend, nor do you have the strength to take care of all these activities, nor do you have the muscle power to ensure that things go smoothly, nor do you have any kind of connectivity with the local authorities to get the clearances, nor do you have experience in real estate. I am coming. I have the experience. I have the funding. I have the background. I am a promoter for so many years. I will get all the approvals, etc. I'll put my own funds to clear the whole thing. And then I will make it a marketable developed plots. What do I get? You get then the developable land, then the agreement comes to 60-40. And finally they say that, okay, out of 100 plots that get generated, 60 you keep, owner can enjoy and sell. 40 will be taken by the developer. Now please understand, developer comes with nothing except his own funding. Landowner who is a 100% owner becomes a 60% owner. But both of them are only rearranging their ownership of plot of land. Landowner retains the developed plots or sells in his own capacity. When that happens, when the landowner sells 60% of his land, it is nothing but sale of land. As I said, plotted land, unplotted land, land is land. So when the landowner sells or the developer sells, there is no question of GST. Now the question is, when the developer develops a large tract of land into plots and gives saleable plots to the owner, is there a service? Now a lot of people get worried by the fact that there must be some GST in this transaction. Let's split the transaction. Developer and customer. It's a pure sale of land. Customer comes, he wants to buy the land, he buys the land, goes. Landowner and customer. Customer buys the land, customer pays the money, customer gets a plot, goes. So what is there between the developer and the landowner except the joint development agreement? Dilution of ownership in immovable property happens in the hands of the owner. And creation of ownership rights to some extent to the in immovable property also happens in the hands of the developer. Is that a service? What is the service that the developer renders to the owner? What is the consideration, if any, for the service that the developer is supposed to have rendered to the owner? If you look at those questions in depth, you will find answers. The answers are, there must be a service. These obviously are not goods. We are very clear we are not dealing with goods. So is the developer providing a service to the landowner when he incurs cost in his own capacity as a developer, and he is identified as a developer in the eyes of law? When he incurs cost and the benefit of that incurring of expenditure gets the land a little more better status as a plottable or marketable plotted land, can you say that a service has been rendered? If so, can you point out what is the consideration for service? That's a key question. Next. Then we go to the next model, because the agreements are similar and identical, only the model differs. In this model, the landowner says, you may give me 60% of the plotted land. What will I do with it? I can't sell. The very fact that I could not sell 100% of the land itself, I came to you. I don't have the muscle power to sell, nor can I market, nor can I advertise. I don't have money. You do one thing. You enter into an agreement with us. You sell everything. Whatever you develop, you sell. Whatever money you get from the sale of plots, 25% you transfer to my bank account. So we get into what is called as a revenue sharing arrangement. So again, if you discern the parties, developer sells all the plots to all the new customers. Between them, it is pure sale of land. Nobody can tax them. Out of that money that is poured into the bank account of the developer, some amounts get transferred from bank account of developer to bank account of owner. Pure revenue share arrangement. Where is the service involved in this transaction? Is there any kind of supply by the landowner? Then somebody would say, no, there are development rights. Because of the agreement only, that builder was able to develop this property. I mean, this developer was able to develop these plots. Therefore, development rights have been conferred. If development rights have been conferred, can they be taxed? Can notification 6/2019 apply in this transaction? Next. So before we understand that, we need to understand what is the development rights that people are talking about. If you're not able to understand what is the development right, then we can't discuss further, because the development rights plays a very critical element both in JDAs of buildings, both in JDAs of plots. While dealing with specific performance of agreement for use of transferred development rights, a very clear observation was made by saying that TDR is nothing but benefits arising out of land, and therefore it is an immovable property. Cheddar housing is a very famous case law, many people would know. And then a fundamental concept called as profite patendre, which is considered as a right of taking soil, gravel, minerals, and the like from the land of another. It is a benefit arising out of land and is immovable property within the meaning of the Transfer Property Act, Anand Behra. So we are going towards a new thought process by saying that land, benefits arising out of land is immovable property, benefits arising out of land is also immovable property. There is a very interesting decision in the context of whether it is a business transaction. See, I'm looking at multiple arguments. Number one is that whether it constitutes immovable property, whether development rights by themselves constitute immovable property. In my view, it cannot be taxed if it is immovable property. The second argument would be that, is the landowner engaged in business? Because for supply under section 7(1) to apply, the supply must be in the course of business, in the course of furtherance of business. So can you say that when 5 children who have inherited property from their grandfather decide to enter into a joint development agreement for the conversion of that land into plots and retain 25% of the sale proceeds and allow the developer to enjoy 75% of the sale proceeds, can you say that these 5 children are engaged in business? So in order that a transaction may be treated as a business transaction, it must be a transaction that answers the above description from the standpoint of both the parties to the transaction. For a developer, it is business. 100% it is business. But is it business for the owners? It is not business for the owners. They are only liquidating their personal assets which they've inherited. They would not even have classified as stock and trade. Even if they are maintaining accounts, even if they are in other activities that require them to maintain accounts, this will be their personal assets, wealth. If wealth tax was there, they will pay wealth on this, wealth tax on this. So the assets that belong to the family do not have the character of business assets. And when those assets are put into an agreement for the purpose of development so that money can be done or monetizing can be done, it is not an activity in the course of business in the hands of the landowners. And therefore, you cannot perceive a supply. So either on the basis that it is immovable property and therefore outside the ambit of GST, or on the basis that it is not even a business activity and therefore it cannot fall in the ambit of section 7(1) for it to be a supply. Next, please. So one may argue saying that, sir, your theory is all very nice. Development rights, I mean, the benefits arising out of land is immovable property is very nice. But benefits arising out of land is immovable property is in some old case law, even though Supreme Court it is under Transfer of Property Act and General Clauses Act. Much closer home, all these judgments are applied in service tax, where the Chandigarh bench of the tribunal in the case of DLF commercial project said that development rights are immovable property and hence cannot be liable to service tax. So much closer home in the context of service tax, you also have a decision which says service tax is not applicable in respect of development rights. And as I said, the alternative argument, supply is not in the course of furtherance of business in the hands of the landowner. And here again, I'll give you one more decision. This is in the context of wealth tax. What happened in this case, in the case of, which was before the AP High Court? A person entered into a joint development agreement. Landowner entered into a joint development agreement with the developer. There was land which was available with the owner. The wealth tax was demanded in respect to the land held by the owner. The owner responded by saying that I have entered into a joint development agreement and therefore I am also in business, and the land that I have put forth for this joint development agreement is my stock in trade, and hence it is not subject to wealth tax. The API court answered this question in the case of Devi Enini, where they said that when purchase of property is an isolated transaction, on execution of joint development agreement, it cannot be said that the owner of land also intended to carry on business using the subject land as stock in trade, since this may very well have decided to part with the land for other reasons also. So the intention of the both parties being in business is very, very critical, and landowners are seldom in that kind of intention. Next, please. Then another argument comes. That argument is, sir, your theory is benefits arising out of land is immovable property. And therefore, you are saying immovable property is outside the ambit of GST. But please refer to Schedule 3. It says only sale of land. It doesn't say sale of immovable property. And therefore, immovable property can be taxed. A lot of views are circulating the market. Therefore, I'm just picking those views and giving my perspective. I could be proven wrong totally in future, or I could be proven right. I don't know what can happen, but I give my view as my view. Fundamentally, this obsession with third schedule as the box all or the exclusive domain to ensure GST is not applicable is not the best way going forward. Third schedule is like a safety valve in a cooker. It gives some protection. That means the Parliament and the GST Council and the states together in their wisdom have envisaged these are all areas which we clearly know that we don't want to tax it. We'll put it there so that abundantly and explicitly and vociferously it is said neither supply of goods nor supply of service. Take one item for example, employee providing services to employer. Now, very clearly there is a service involved. An employee is paid monthly salary only for providing his services. Very clearly there is a service rendered, but you cannot tax it. You don't want the employees also to go into agitation. Therefore, how to protect? Exemption is the risk, because somebody might say exemption means, we can withdraw at any point of time. Declare it as neither supply of goods nor supply of services. Like that, they put sale of land. It was not as if they intended that sale of land alone will be specified as outside GST, sale of immovable property will be taxed. This sort of fine distinction was not in their mind. Their objective was to put some transactions there. For example, take the high seas sale. It was not there originally. What happens in a high seas sale? I place a purchase order on a supplier in Germany. While the goods are coming into India, I transfer title in favor of somebody else. And that person becomes the importer. This is nothing but a transfer of documents of title to the goods before they cross the customs frontiers of India. It was very clear that this was not subject to GST, but people were raising doubts, and therefore IGST Act was amended, and one more entry was added to third schedule. only to make it abundantly clear that we don't intend to tax this transaction. Now, many of you are chartered accountants, and as chartered accountants, you also operate in the format of a partnership. So there could be 3 partners in a partnership firm or 4 partners in a partnership firm. As a partner, you get salary from your firm. Now, are you charging GST on your partnership firm? Is the partner charging GST on the firm? No. When you go and ask why, they say, sir, partner is only drawing out from a share of profits. The salary is only an appropriation of profits, and therefore there is no question of GST. But it is not there in the 3rd schedule. If it is not there in the 3rd schedule, then theoretically it is taxable, isn't it? That is why I said you should not be obsessed with the 3rd schedule. Dividend from shares. Are you going to say it is taxable? No, sir, there is no service involved. Now you are back to the definition. Therefore, 3rd schedule is giving some clarity. But it doesn't mean that it is the end of everything. There are other transactions which may not find place in the 3rd schedule, but may not involve supply of goods or services and therefore not liable to GST. Immovable property is one. Plot, we are very clear it is land. The doubt in the content development rights. So development rights, if it is considered as immovable property, merely because immovable property is not specifically identified as a species in 3rd schedule, it does not mean that it can be subject to GST. Entry 49 list Roman 2 7 schedule constitution covers taxes on land and buildings. What is land? If you look at the language of the Supreme Court in the case of Anand Mills, not only on the face of the earth, but everything under or over it, and has its legal signification on an indefinite extent upward and downward. 101st Constitutional Amendment, which facilitates the implement of GST. Article 246 was brought in, Article 279 was brought in. So many articles were brought in for facilitating GST. So many entries were amended. Entry 84 of the Union list in the context of excise was amended, whereby excise is now confined to only 6 products. Entry 54 of the state list is amended, whereby VAT can be imposed only on 6 products. Entry tax entry was abolished, was omitted. Entertainment tax entry was modified to enable municipalities to levy entertainment tax. In all these amendments, entry 49 was untouched, which is tax on land and buildings. So entry 49 still remains as it is. 101st Amendment of the Constitution has not touched this. Therefore, there is no question of GST on a transaction which involves immovable property. Maybe in the future it can come. But right now, there is no question of GST on immovable property. Next. Now, let me look at the Madhya Pradesh stamp duty structure. It's very interesting because, as I said, in real estate, GST is not the only tax. You also have to examine the applicability of stamp duty, and Madhya Pradesh seems to have very interesting structures. So you have an agreement without possession. Then you have a builder's development agreement with rights. Then you have construction agreement with rights of holding or selling. And you have an agreement where, this kind of modifications are there. And the Madhya Pradesh is quite clear where it is compulsory. They identify what is the amount of stamp duty payable, what is the amount of registration fee that is payable. All that is very clear. Next. They talk about conveyance. They talk about conveyance in execution of an agreement in pursuance or in furtherance of in compliance of an earlier agreement. Conveyance in compliance of a power of attorney with consideration. This is the first time coming across this entry, because normally power of attorney you don't have consideration, but in this entry you have consideration without consideration. In all those transactions, they identify if it is compulsory, if it is registration, how much is duty payable, how much is upkar, how much is everything else. Next. Therefore, why I'm giving the structure is all kinds of transactions which we discussed, this Raman Co transaction, the joint venture transaction, all those transactions. There are documents which are executed in the parties, which are subject matter of registration under the Madhya Pradesh laws, state laws. There is a payment of stamp duty on the transaction. There is a payment of registration fee on the transaction. So my fundamental question is, where the document is registered and subject to stamp duty by the state, can there be a levy of GST under Article 246A? Now, interestingly, if you look at it from a constitutional perspective, the fundamental argument that is always put forth in challenging a levy would be that this is the subject matter of, say, state, and therefore center cannot levy, or this is a subject matter of center, state cannot levy. So the argument should be based on the union list and the state list, saying that this entry is union list, entire domain is with union, state cannot legislate, state cannot tax, or this entry is completely state domain, center cannot tax. And that is how GST was born. Service was on the residual domain. It was not an identified segment. Entry 97 was the source for Finance Act 1994, and therefore only Parliament could levy service tax. After GST, states are empowered to levy GST on services. Before GST, center was empowered to impose only excise duty on manufacture and removal. They could not tax everybody in the supply chain. After GST, manufacturer, wholesaler, distributor, sub-distributor, retailer, every supplier is taxed, even he sells goods. Therefore, the earlier arguments were to the effect that this levy is confined to this jurisdiction or this authority. You are encroaching into it, and therefore it is not valid. Now, I'll borrow all those arguments and say that when for a number of transactions, the power to levy stamp duty and registration is with the state, and these documents are registered and subjected to stamp duty and registration fee, can you still call it a subject of taxation under Article 246A? Because when 101st Amendment was made, no amendment has been made to entry 63, which deals with stamp duty, or entry 49, which deals with land and building. Those entries remain distinct and separate and independent. Central government has got its own power to levy stamp duty on certain instruments. State has got certain powers to levy stamp duty on certain instruments. Very clearly, lines are drawn between them. 246A cannot encroach into those lists also. What is 246A? It is an amalgam of sale of goods and sale of services. Now beautifully called as supply of goods or services. When you are mixing, let us say, milk and decoction together and call it coffee, you cannot call it tea. You don't get the right to get into another segment. That is still not touched. Taxes on electricity, still not touched. State has the power to levy tax on electricity. Therefore, till future constitutional amendment comes, when all this gets roped into GST. Today, these are exclusive state domains. Therefore, if the state has exercised their powers and passed a particular law, where all these transactions, that's why I narrated all the entries in Madhya Pradesh. Whatever discussions of Ram and Co. and joint ventures are captured in those entries in Madhya Pradesh law. In all those transactions, when the power to levy stamp duty and registration lies with the state, and those powers are very much there, can you say that the very same consideration I would also subject to GST? The answer is no. Answer is a vehement no. Then somebody might say, sir, even under the old law, there is something called as aspect. This is a famous aspect theory. What is this aspect theory? The manufacturing aspect can be subject to excise duty. The selling aspect can be subject to sales tax. The profit aspect can be subject to income tax. The entry aspect can be subject to entry tax. The service aspect can be subject to service tax. So Supreme Court as well as high courts upheld certain levies on the ground that no, they are not entering into the domain fully, they're taxing only one aspect of it, and that is permissible. Then the logical and legal question that follows: which is the aspect which you are trying to tax in GST? If you tax the entire consideration, which is the same consideration for stamp duty, you're taxing the land. If you say that there is some element of service sitting inside, the development rights can be perceived as a service sitting inside. Where is a valuation mechanism for culling out that? Where is a valuation mechanism for eliminating the land? Where is the valuation mechanism for knocking out domains which you have no power to tax? That is how the earlier judgments were there, in Delhi High Court 26/2012 service tax, when questions came whether 25% mechanism in construction of complex service was valid or not. The court said that 25% by assuming service, you are not eliminating the actual land value and goods involved. There is no rule provided. There is no mechanism provided. So where is the valuation rules which allows the elimination of land or immovable property from this transaction? In the absence of that, taxing the entirety is not permissible. Next. Now coming to the revenue share model. Now, as I said, in the revenue share model, the money is collected by the developer and a certain percentage of the money is shared with the landowner, whether this is a service involved. Now look at the last para. There is no service rendered by the appellant and the money flow to the assessee from SWPL under the nomenclature of royalty is not a consideration for the rendition of any service, but in fact represents the appellant's share of revenue arising out of the joint venture being carried out by the parties. I have land, you have development capabilities. Let us together go to the market. Let us together market it. You be the front, you yourself call the developer, but give me money because it is my land. So when the landowner and the developer goes to the market and market the plots together and sell the plots together, and out of that money that is collected, a portion is given back to the owner. It is nothing but a share of revenue arising out of the whatever JV that they call in respect of this transaction. And there is no rendition of service inter se. That's a beautiful point here. No service is rendered between the parties concerned for it to be taxed. Now, as far as GST is concerned, we are dealing with the service because there is no goods involved. Of course, somebody will say, sir, service is defined as anything other than goods. Does it mean that there need not be a rendition? There must be a supply of a service. What is the supply involved here? Nothing. Next. Cricket Club of India versus Commissioner of Service Tax. Mumbai bench of the tribunal held that mere flow of money from one person to another cannot be considered as consideration agreed upon for any specific activity. State of Bengal versus Calcutta Cricket Club, while holding that there cannot be any service tax on a club based on the principle of mutuality, also held that there has to be an activity carried out by one person for another. What is the activity carried out for consideration? And where is the identified method for such consideration? Where is the discernible mechanism through which you can identify such consideration? You can't say land value is the consideration. I mean, there is land consideration. Next, please. Look at the Apollo decision. We argued this matter. The tribunal held that the portion of the fee collected by the hospital and retained towards collection charges or facilitation fee is also in the nature of a healthcare service and is not liable to service tax. So the analogy is equally applicable, and the share of revenue from the sale of land can also have the character of revenue from the sale of land and therefore not taxable. So if the money for this, if what I receive is for the sale of land, and out of that, if I pay something for the other because he has given the land, that also has got the character of sale of land. And therefore, we can say that the revenue share does not involve rendition of service or provision of service or supply of service by the developer to the owner for it to be taxed, or for the owner to the developer for it to be taxed. Either way it works. Next. When developer sells all the plots and shares an agreed percentage with the owners, it is a pure revenue sharing transaction. There is no supply of service between the parties, and the landowners is like, and one more aspect is, how is the landowner going to treat this money in his accounts? He is not going to say that these are, business revenues. He'll probably say these are pertaining to investments which he had and is now liquidating them. And therefore, service tax provisions can be applied. Next. development rights is referred to in two places, 4/18 as well as 6/2019. Notification 4/2018 says that time of taxation of transfer of development rights will not be applicable. I mean, my view is that it will not be applicable because it says the notification would cover registered persons who transfer development rights. Landowners are not registered persons. Secondly, the consideration received for the transfer of development rights should be in the form of construction of complex, because in a joint development agreement between a landowner and a developer which involves a construction of complex, the landowner decides to permit the developer to develop the complex, and in lieu he gets constructed flats. And therefore, one possible answer there is that there is a service rendered by the developer to the landowner in the form of a construction service. And therefore, the lawmakers felt that it should be taxed. We could get back to different debate as to whether it is taxable or not, but that is not the subject matter of today's discussion. So I'll skip that. But my simple answer would be that 4/18 will not apply because it talks about a different scenario. Next. 6/19 will also not apply because it is against the consideration payable in the form of construction. As I said, construction is ruled out. Next. So what would be my answer? What flows from the landowner is development rights. We are very clear on this. From the landowner, developer gets certain rights. What are those rights? He can enter the land. He will not be a trespass. He is licensed to enter the land. He is permitted to apply for all the permissions. He is permitted to do what all is required to develop that land into a pakka layout. He is permitted to approach the market. He is permitted to sell. He is permitted to enjoy 40% of the land which he never had before. Keep the money. 60% of the plots you give to me. So, can you then say what comes from the owner is only development rights? Owner who was a supreme owner of 100% of the land is now a diluted owner of 40% of land. In area share, he loses ownership. Therefore, he owned 100% of land. He now is only owning 40% of land. That means 60% of the land has gone to the developer along with development rights. So it is not only development rights, but land also has gone. Therefore, strictly speaking, since landowner loses ownership rights over an area of land, and in lieu of that, he gets developed plots, there are two items that move: land as well as development rights. Land is immovable property. Development rights can also be considered as immovable property. If you want to say, no, development rights should be perceived as a service, please tell me how to value these development rights. There is no mechanism. In the absence of a mechanism for valuation, in the absence of mechanism for a computation, the levy fails. BC Senior Society, Supreme Court. So there is no way you can identify a monetary value for development rights, even presuming or even assuming that it is a service. You take a view that it is development rights and immovable property, there's no question of GST. But if you take a view it is a service, please tell me how you can identify a value. Because you cannot say selling price of the land. Land is not something which is involved here. Land is the dilution of ownership of land. Therefore, it is sale of immovable property again. So how do you find out what is the development rights? Then can you say that the expenditure incurred by the developer for developing all this land should be the, but he's incurring the expenditure for himself also? Then will you then say 40% of this would be treated as the consideration? Far-fetched. Where is the rule for all that? Where is the valuation mechanism for all that? There must be a specific rule, like how you have a rule for pure agency, how you have a rule for different elements of valuation. You must have a mechanism. If you don't have a mechanism, it's difficult. Next. Last topic for the day, power of attorney transactions. Landowner gives power of attorney and permits a developer to develop the land into plots. Landowner receives consideration being a share of the sale proceeds. Is it a transaction of sale of land in the hands of the owner? In the absence of a transfer of title in favor of the developer, can it be said that the landowner has supplied a service to the developer? And what happens if the plots are sold at a higher price in transactions where the owner is paid an upfront amount for the land at the time of granting possession? These are very peculiar questions. Landowner gives a power and collects 1,500 rupees per square feet and says, you do whatever you want to do. Leave me alone. I won't bother you. You won't bother me. Developer sells it 2,500 after doing all the work. So what is the nature of 1,500 received in the hands of the owner? Is it for the sale of land or is it for a rendering of service? Obvious answers. Or can somebody come and say, you only gave a power, you have not actually transferred title. 1,500 does not represent sale of immovable property. The 2,500 which the developer got from the customer is your consideration. That is your sale of immovable property. That is on which you have to pay tax. Next. Mumbai bench in the case of Viraj Estates has held that purchase and sale of land does not fall under real estate agent services. The department had contended that consideration received cannot be considered a sale process, as one cannot sell something which one does not own or has title, and hence the activities are in relation to sale of land from owners of land. So this was exactly the argument put forth by the department by saying that developer is operating only under a power of attorney. Therefore, the money received by the owner is not towards sale of land because it's only given power, and hence it is a service. But then ownership is something which is very different. Of course, transfer of title is critical, but there are ways through which ownership can also happen. 53 of the Transfer of Property Act is also there. There can be an agreement and a possession. So there can be an agreement for sale and you give possession of the land. There could be a transfer. Not only transfer of property, it could also be a transfer for the purpose of capital gains under the Income Tax Act. Therefore, if the law presumes ownership is getting transferred because of certain acts and deeds, then whatever consequences flow out of such ownership transfer should also flow. Next. A very interesting judgment from the Supreme Court in income tax in the case of Sanjeev Lal, where Supreme Court held that in normal circumstances by executing an agreement to sell in respect of immovable property, a right in person is created in favor of the transferee. When such a right is created in favor of the vendee, the vendor is restrained from selling the said property to someone else because the vendee in whose favor the right in person is created has a legitimate right to enforce the specific performance of the agreement if the vendor for some reason is not executing the sale deed. In the context of Section 247 of the Income Tax Act, one can say that if a right in property is extinguished by an agreement to sell, the capital asset can be deemed to have been transferred. So we go one step further to say that even in such cases, there could be a transfer perceived under the Income Tax Act. Next. The Allahabad High Court in the case of Mehra has held that it is apparently clear that the moment an agreement to sell is executed in the parties and part consideration is received, transfer for the purpose of Section 50C of the Income Tax has taken place, and computation of Section 48 will start accordingly for the purpose of calculating capital gains under the Income Tax law. Next. There's an elaborate set of facts, but I would suffice to say that one of the arguments that was raised was that the power of attorney was given, possession was given, money was collected. Based on the power of attorney, the other fellow sold lands later. The first fellow said, I will pay capital gains only when the ultimate sale deeds are executed few years later. The tribunal said, no, your transaction is over. You have given possession. You have completed all Section 53 of the Transfer of Property Act, and therefore the transfer has already taken place. You pay capital gains now itself. This also demonstrates that when the power of attorney is given coupled with possession and consideration flows, it is a sale of land transaction. Where is the sale deed? There is no sale deed, but there is a possession given and a power given and a right to sell given, and consideration also passes in full. And that is why Madhya Pradesh stamp law is very interesting, because it talks about a power of attorney with consideration also. I have not seen many states having that entry. Next. So in power of attorney transactions, possession is very important. Full payment of consideration or agreement for payment of consideration is critical. What are the rights given on the developer has to be very important, we have to be understood carefully. How do you treat this in income tax? And then you look at impact in GST. So it has to be a holistic approach to the entire transaction. Next. Kishan, we are now at 5:20. I've covered all the issues as far as plot development is concerned and plots is concerned. I have a couple of slides on the construction segment, but since audiences are there, I would rather take questions on the topic that we just discussed instead of proceeding on this. The slides are available, they can be shared if somebody requests.
Okay, we can continue for 5 minutes at least, sir, if you are comfortable.
Yeah. So next question is whether 5% is the only option in construction of complex. See, this is what I'll give a brief. I'm not going to the slides. I'll just quickly talk about so that people understand. Many of you know the subject quite well. 2017 GST came. Lot of issues were raised in the context of construction. And in 2019, 1/4/2019, this new notification 3/2019 came and completely changed the whole scenario and said that pay 5%, don't take ITC. Now that's a chaotic distortion of the GST law. The beauty of GST is input tax credit. Now, why did the government do it? They thought that it will be very favorable to the public at large and also developers will like it. See, it worked for hotels. Hotels had the same issue in terms of GST high rates. It became 5%. Public were happy because hotels are B2C. And hotels, small hotels, medium-sized hotels, small food restaurants where AC also is not there. Your raw materials and inputs are unlikely to have GST. Vegetables, fruits, meat, poultry, none of them will have GST. Therefore, the question of ITC was left to certain kind of restaurants which are at a higher end where they had AC, they had service, they had rentals, etc. So the majority of small hotels were very happy with the 5% without ITC because they can charge 5% of the customer compared to the old rates. So this populistic solution was applied to real estate also. And they said 5% without ITC, without realizing that in real estate, cement attracts 28%. If you don't get input tax credit on cement, your cost goes up. If your cost goes up because you cannot get GST credit, your price goes up. If your price goes up, ultimately the customer pays more, even though in the bill, he will see 5%. The consideration or the sale price has already gone up. Now, recently, you saw in the, probably have not seen the outcome of today's GST Council meeting, except that there is some discussion going on about the cess. One of the key elements under discussion is the COVID issue. And the debate is around COVID vaccines and COVID medicines, with some of the states asking for exemption. And our finance minister has replied, at least before the council, prior to the council meeting, that why it is economically not feasible to give exemption. If you give exemption for a pharmaceutical product or a drug, then the price of the drug or the product will go up because the pharma company would not be able to claim input tax credit, because if it is exempted, their cost goes up. There is nothing wrong in this logic. Perfect. This is the economic understanding of GST. Exemptions will create distortions and exemption will increase cost. It's a separate matter that I've written another article as to how to get over that problem and still give relief to the industry. Those of you who are interested can read it. It appeared in Business Line. But the point is, if the government is very much in tune and in sync with the economic aspect of GST and can clearly understand that an exemption or a lower rate without ITC would increase prices, then it baffles me as to how this economic logic is not applicable to real estate. Same problem for developer. If you pay 5% without ITC, your cost goes up. So denying of ITC is equally an economic distortion. So if one can understand the economic aspects of GST, and that is why exemption cannot be given for pharmaceutical products, You can also apply the same logic and increase the rate of duty to say 8% in real estate and give the input tax credit if 5% is a lower rate for which you cannot give. So if you have to live with 3/2019 and suffer the cost increase, I'm just putting one idea, whether 5% is the only option. That's my exploration of the thought process. If you read 3/2019 with all its columns and conditions, etc., it's more of a commentary than a notification. 3/19 amends 11/2017. 11/2017 is issued in exercise of powers conferred by section 9 and 11. 11 is the power which gives 11 is the section which gives the power to give exemptions. So my view would be the 5% with conditions, A, B, C, D conditions to be satisfied, should be perceived as a concessional rate in the form of an exemption with conditions. Because under 9(1), you can only notify rates. You cannot notify rates with conditions. But exemptions, you can issue with condition or without condition. So 5% should be perceived as an exemption notification providing for a lower rate of GST with a bundle of conditions. Therefore, whenever there is an exemption notification with conditions, it is called as a conditional notification. If it is a conditional notification, it is optional. If it is optional, I can choose not to go by the conditional notification and pay the full GST rate applicable and enjoy the ITC. Imagine a worst case scenario, somebody follows 5% regime and avails ITC. What can happen? The revenue authorities can come and say, look, you cannot avail ITC because you're under 5%. That means I have violated the 5% condition. Then you should put to 18%. Reversal of ITC is not what is contemplated. Reversal of ITC requires 17.5. But in notification, if you say that you have breached the ITC condition, full rate should apply. If full rate should apply, I may as well enjoy the ITC. Therefore, my thought process to end the session is that 5% is not the only option, and one can explore, of course, subject to degree of litigation, the possibility that you can pay a full rate applicable and then you can take a view that I am entitled to ITC. And when you're paying the full rate, of course, land cannot be subject to GST, only the construction can be subject to GST. With that, I will conclude my session and open it for questions. If somebody can moderate the questions, I can answer the questions. Thank you to the Institute, thank you to the Indore branch, and thanks to the Tax Practitioner Association of Indore for hosting me today and giving this wonderful opportunity. And thank you, Kushan.
Thank you so much, sir. Sir, it was really an eye-opening session, and you have considered all the aspects of GST on plotted development of land. But still, there are certain queries from the audience. So, Apar, can you put all the queries here? One query is from SC Bansalji, Satish Chand Bansalji. He is of the view that since developer is getting 40 plots for developing the land from the landowner, so whether it cannot be considered as a consideration for providing the services. Just like the same case of this Madhya Pradesh advance ruling.
See, fundamentally, you can look at consideration if you can establish that there is a supply. So first thing that has to be demonstrated is there must be a supply by a developer to the owner. Then it is supply for consideration. And then if you look at the definition of consideration, is money is payable or money is paid on behalf of somebody. The second category of consideration, which talks about monetary value, is linked with something else. And you can't take the entire value of land and say that the land is the consideration for the development. That means what you're indirectly doing, you're saying this removing of shrubs, etc., removing of bush, etc., applying for a permission, etc., is such a big activity that 40% of the market value of land is the consideration for that. That would not be acceptable.
Okay. So, I mean to say that we should value all these services. Provision in valuation rules. If there is a residual method is there, if we can value that services 110% of the. Is it
One
possible, sir?
methodology would be to identify a separate consideration for development. If the parties could restructure their documentation or the future transactions, if they're able to identify that land is separate, and in addition to that, since you're carrying out development which is beneficial to my 40% of the land also, you will be entitled to rupees so and so towards development charges. If you are able to identify that in your documentation, then that will settle the issue if you don't have to go to any other debate. But in a worst case scenario, if development is perceived as a service, then the cost of development plus 10% would be an ideal.
Okay. One query is from Mr. Harsh Jaju. Developer has provided services of development of land to the landowner. Are you getting that question, sir?
Yeah, I can read it.
Yeah. So, a developer is providing services of development of land to the landowner. This development service includes obtaining all the required permission from local authority, government department. It also includes. So, he's of the view that this is covered under works contract services. Whether it is correct?
I would not agree it is works contract because works contract is defined under 2119, and that requires transfer of property in goods in the course of execution of contract, which involves commissioning, installation, etc., removal property. So, obtaining a planning permission or obtaining local agency clearances and all cannot be called as works contract services, merely because they are in connection with land. If you look at that way, then a real estate broker who's selling land on behalf of the owner would become works contract service provider. So, just because it has got some relevance to the land, it will not become works contract.
But sir, he is developing the area on behalf of that whatever.
So the question is he developing the area on behalf? Then it could become an agency service being done for the principal. So where is the consideration identified for that? See, you need to identify a rendering of a service. So if in a joint venture, if you are able to pinpoint and say that 40-60 transactions, this much represents the development work carried for my 40. This much represents the development work carried for your 60. Then I can understand to some extent you're able to say that. But what he develops is whatever expenditure is incurring, he's incurring in his capacity as a promoter. He is promoting the entire land. And therefore, it becomes a self-service to some extent because he's incurring those expenditures. Now, benefit of the expenditure flows to this fellow when plotted land is handed over. So when plotted land is handed over, that value of the plotted land cannot become the consideration. But raw land has become plotted land on account of some development work. Is there a service rendered in that? That service is also related to immovable property. It is, it is like, some kind of leveling of the land that has been done, etc. Now, if you say licensing work is done, permission is obtained, etc., etc., does the permission involve permission for the developer to sell the property, or the permission also percolates down to the owner to sell the property? The answer is no. The permissions are all in the name of the developer. The permissions are all belonging only to the developer. He only takes title to all those permissions. He incurs all those permissions, the expenditure, etc. Therefore, you cannot say that the permission has been obtained for the owner. It's obtained for himself.
Okay. So one question is from Arvind Singh Chawla. What he's saying that losing of land by a landowner clubbed with possession and development right therein involves transfer of ownership by landowner, which is never intended by landowner, and will involve stamp duty on land side. So one more question is there from Arvind Singh, that whether we, as you explained earlier, TDR is not applicable in this case in developing the land. So can we use this terminology in construction of residential and commercial complex also?
There's no difference between the development rights in construction vis-a-vis development rights in land. Development rights are development rights per se. So you give a right to develop plots, you give a right to develop apartments. In the case of apartments, what the government has done is they've identified that there is a development right, and they've decided to tax the developer under recipient of under RCM mechanism. In the case of development of plots, they have not done anything. So even if development rights are involved, it is yet to be taxed in any form.
Okay. One question is from Sandeep Srivastav. So he wants to know whether it means no GST on development rights in case of joint development agreements. He wants a direct answer to this question. Is there any service involved?
My view is that development rights also have the same character of immovable property, benefits arising out of land, and therefore they cannot be taxed.
So he wants to know, sir, there is no service involved. Suppose you are a landowner and I am a developer and I am developing the land. So I am not providing any service to you. This is the question.
No, that is the answer also.
Okay. Can you put this query of Harsh Jaju? In the case of plot, yeah.
One more thing is that you need to understand there is a difference between development rights and transferable development rights. See, FSI is a different game. FSI is a scenario where you have this special permission to put up a certain level of floors or certain heights more than what is prescribed because you have that extra FSI which you bought from the market. Or in Mumbai, if you look at a redevelopment kind of a scenario, you will find that the existing owners confer certain development rights on the developer to demolish and construct and give them back their new apartment, and further apartments are sold out. In the case of plotted development, the development rights are not in the nature of transferable development rights. The development rights do not involve FSI. The development rights cannot be perceived as some kind of extra FSI or extra right that you are getting. What are you getting rights? We call it development rights for the simple reason that if I don't give this right or if I don't give this permission, the act of the developer entering the property and doing those activities become illegal. If the developer has to enter land belonging to the owner and carry out all these leveling activities and cleaning activities, etc., you can do it one way. You can engage a contractor, call the contractor, look, I own this 50 acres of land. Can you level it up, clean up everything? Now that is a pure service which he renders, for which you will remunerate. Instead, you go to a developer and then say, can you do this JV, where you get certain rights, I get certain rights, you sell the property, area share, revenue share, whatever, etc. The difference is that you are giving him special rights to even sell. You are giving special rights to diminish your ownership of immovable property. You are allowing him to step into your property and portray to the world that he is a developer, and therefore you are giving him certain rights. Those rights need not be the same as PDR or FSI. They just per se rights. The rights involve immovable property.
One last question from Mr. P.K. Das. If a landowner cum developer sells partly constructed plot up to plinth level, after booking, will the amount spent on part construction will attract GST, and what will be the GST impact?
I didn't get the question.
Should I repeat it?
Yes, please.
If a landowner cum developer sells partly constructed plot, it means construction has been done on the plot up to plinth level. After booking, will the amount spent on part construction will attract GST?
See, what is happening is there is he's doing some kind of house construction. So for a plot, he's putting up some part house or some level of construction, and then he gives it to the customer. Now,
Yes.
to that extent, there is a service rendered because construction is definitely a service. So, assuming he converts his land into plots, builds houses, gets completion certificate, sells it as a whole package of land plus building, it is sale-of property. And anyway, post CC, no question of GST even for the construction. But if he is selling the plot of land along with some construction segment done on it. If it has got the character of land plus building and sold as a full conveyance, he may still escape by saying that it is a half-finished structure which I'm selling as a sale of immovable property. But if he decides to enter into a construction agreement and collect money for the construction of that and have a sale deed for the plot of land, then there could be an element of services. So it depends upon how they propose to execute the transaction.
Thank you so much, sir. Friends, now we are bound to conclude this session. Friends, now we are bound to conclude this session. Before that, I would like to share one thing, that when I sent a WhatsApp message to Vaidhi sir, he within a fraction of a minute gave his consent for this webinar. So friends of TPA and ICAI Indore branch, I extend my sincere thanks to our today's speaker, Vaidhi sir, not only for accepting our request to be a speaker of this session, but also for his wonderful deliberation and sharing his knowledge. Special thanks to all the audience who attended this seminar from various cities, not only from MP, but across India. Thank you very much, friends, and thank you, Vaidhi sir. Goodbye, friends, and take care. Thank you so much.
Thank you so much. Thank you. Nice.
It was wonderful, sir.
Thank you, sir. Stay safe. Please be safe, all of you. Thank you. Bye.